Hey everyone, Eric here. In this video, I'm going to explain to you when to capitalize software development costs and walk through the income statement, balance sheet, and cash flow implications of these decisions. Okay, let's get started. So, before we sort of dive into this example, and we're going to walk through a full P&L balance sheet and cash flow statement and sort of compare two situations, one where we're capitalizing software development costs and the other where we're not capitalizing software development costs. But before we do that, I want to kind of talk to you about how we got to today. So, the historical way of sort of dealing with software development was that we capitalized everything to the balance sheet. So, in case you don't know what that means, it means that we basically took the cost off the income statement and instead put it on the balance sheet as an asset and then depreciated it. And the reasoning was basically because people said, or accountants said, that this code that these software engineers are writing is an asset. It has a useful life, like we'll be using it in the future. So it's not just like a traditional expense where you spend the money and it's gone. And so the theory is that you don't want to overrepresent these, for instance, long term investments you're making today. So instead, capitalize it and then depreciate it over some period of time that we think this software is going to be good for, similar to any other asset. So, like a factory or a piece of machinery, etc. The issue is that software is not like code that you wrote, it's not sellable. And that sort of line of reasoning could be extended to anything. You could say, oh, well, the person who runs HR worked on a project that we're going to use next year, so we should capitalize her time. Oh, the CEO made a strategic plan that we're going to use for the next 3 years. So basically, you could extend this line of reasoning to anyone that's doing anything that we'll use in the future. And so it's actually not that defensible if you think about it. And the issue too is it distorts the P&L. It makes the net income look really high today, and then it is an absolute disaster later on when all the depreciation starts hitting. And so you'll see that in a sec. So that was sort of how they always did it. And right now we're moving away from capitalizing software development costs just in general, and we're moving towards just expensing them like any other type of compensation. So the the sort of reasoning behind this is it's compensation like any other compensation. If we are paying people to work, put it on the income statement. Don't take it off the income statement. Either way, the cash is gone. So it won't. It's just because your net income's higher doesn't mean you have more cash. The other thing is that it lowers your net income more, which actually gives you more of a shield from taxes. So even though the same cash outlay is happening around the software development, you'll actually pay less taxes. And we're going to look at that here in a second. And it's a very interesting argument for expensing your software development. The issue in terms of expensing software development costs is that, okay, yeah, you're going to see higher expenses on the P&L if you're building something. But I mean, for me, that's not an issue. You just see a P&L that represents, compensation that the business is paying. So my opinion is stop capitalizing software development costs. It looks ridiculous. It makes the P&L completely useless. If you've done it in the past, just basically expense all these assets onto the P&L in one move and just move on. Because these are not assets that you should be holding on your balance sheet because you can't sell them. They're not they're just distorting all of your financial statements, and then you're having to deal with this rollover depreciation from years in the past. So let's walk through the actual income statement right now, balance sheet and cash flow statement. And basically what we're going to look at is two situations side by side. So we're going to look at historical, so sort of like how they dealt with software development in the past, meaning capitalizing it, and sort of how that rolls through the three financial statements. And we're going to say this is month 1 and month 2. So it's like a 2-month period. And then now, most startups at least are moving towards basically just expensing everything now. And I'm going to talk to you about how it hits your financial statements differently. And actually, there's that tax shield, which is favorable for cash. So let's talk a little bit more about this. So historically, and obviously I oversimplified this, but it's just to kind of call out specifically this software development depreciation thing. So this is a fake P&L. I just made it up. And so this business, say, did 400,000 in revenue in month 1, 500,000 in month 2. You have your COGS, and then you have your gross margin going from 300 to 360,000. So here in the now columns, I have the same business doing the same everything, same software development, but in the historical situation, we're capitalizing it all, and in the now situation, we're expensing it. But it's the same numbers across the board. So if we get to the OpEx, now we have our payroll, which we're saying is the same. And you can see the difference between basically month 2 is 0. So up to this point, we're the same. But then in this situation, we took all the software development costs in the historical situation and we removed them from the P&L and we put them onto the balance sheet here. So in the current situation, the now situation, we said, okay, 80,000 of software development and 90,000 of software development. So total, that's $170,000. In this situation, we took all of it off the P&L. We put it on the balance sheet as an asset. So obviously this looks kind of weird. And then we began depreciating basically the cumulative total over a 36-month or 3-year time period, which is actually usually the useful life of software from an accounting standpoint. Although I've seen people stretch it out to 5, actually even saw 7 years once, which is just absolutely ridiculous. So then effectively what you have is this depreciation of 2,000. So what you're saying is that you put in 80 grand this month, but you're going to be spreading the cost of that investment over 36 months. So if you move down here, your total operating expenses, we're saying G&A, this is general and administrative, like miscellaneous operating expenses. We're saying, wow, look how low our OpEx was. We did all this software development, but because it's for the future, we only spent $2,000 if you think about it over the lifetime of the software. So for me, it's ridiculous. You know, we spent $170,000 in software development. We should just put on the P&L. But in this situation, we basically only recognized $2,000 of it. Now we just put the expense on there. We said we spent the money, it's gone, and we're not going to have to deal with this depreciation, $2,000 per month for 36 months into the future. So in this situation, you have lower OpEx. In this situation, you have higher OpEx. And then you have your operating income, which is obviously your gross margin minus your OpEx. So in the historical situation, this basically pads your operating income and your net income. So it inflates your net income because you're like, look, we didn't spend a penny on software development in month 1. So it makes your net income look like it's $45,000 or $60,000 of operating income, and then you'd actually owe taxes on that profit. And so first off, the thing about the taxes, there's actually a lot of really crazy tax rules about all different types of expenses. So if you're an accountant, I'm sure I'm oversimplifying this, but I just want to kind of explain that you actually miss the tax shield benefit by overcapitalizing certain things. So let me know in the comments if you have a more sort of specific framework for this. But in this situation, you would actually have to be paying taxes. So that would be cash out of the business, even though the same amount of $170,000 went out of the business on software development regardless. So in this situation, if you put the full expense in the P&L, your operating income is negative, so you're not going to be paying any taxes. So, I mean, the obvious reason why people like to quote unquote capitalize their software development is because it makes your business look like it's more profitable than it is. But from a cash flow standpoint, it's not at all. So any sophisticated outside party would just look at your cash flow statement and see what's happening. And so for me, it just makes this whole entire income statement sort of confusing. And so I advocate for people to do it this way just so that your income statement is more logical. So if we move down to the balance sheet now, I'm basically saying that we started the month in both of these situations with $1 million. And so basically down below, I made a really, this is obviously, I didn't include all of I didn't even create a liabilities section because this sort of analysis that we're doing right now doesn't have anything to do with liabilities. But I'm saying we started in month 1 with $1 million in the historical sort of analysis and the now analysis. But if you look at this, in the historical analysis, we had $45,000 of net income after taxes. But we still actually had to spend the $80,000 on software development. So we're actually getting hit because we're having this taxable event happening, even though all the cash went out the door and made the business cash flow negative. So you're getting hit with a tax payment on a negative cash flow month already. So actually you have negative $35,000 of cash flow. Whereas if you just basically put these expenses into the OPEX, you don't pay that $15,000 of taxes. So actually your cash flow is only negative $20,000. And so if we look at month 2, here we show the software going up. And so obviously in the CapEx section of the cash flow statement, which would be in the cash flow from investing section, which is the investment in assets, you see all the cash going out of the business. But the issue is that because your net income is positive and you're paying all these taxes on your quote unquote positive operating income, again, you get hit with taxes on top of negative cash flow again. And so $25,000 goes out of the business, where in this situation, you only have $5,000 going out of the business because you basically, from a cash perspective, you only lost $5,000 and you didn't have to pay for this taxable event. So the interesting thing is by putting the expenses into your P&L in real time rather than kicking them onto your balance sheet and then dealing with the depreciation later on, you actually pay less taxes today. And so you can keep more of your cash today. And so at the end of these 2 months, you actually have $36,000 more cash, and you're not going to have to deal with a bunch of depreciation hitting over the next 36 months, making your income statement look crazy. So the advantage of having that depreciation is that depreciation will provide a tax shield in the future, but I would rather just have more cash flow today than be able to sort of pad my net income, say, 2 years out, because I don't really know what 2 years from now is going to look like. Okay, so I hope this gives you some perspective on the pros and cons around capitalizing software development costs and sort of how it's going to impact your taxes and your net income. By the way, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, join the waitlist in the description below for a chance to join the next cohort of my training program, Finance for Startups. And as always, in the description, you can download this Excel file completely for free. And finally, if you found this content valuable, please like and subscribe. Only 10% of the people that view my channel actually subscribe to it. Thanks for watching, and I'll see you in the next video.